back to the municipal market. We're joined by Nora Wittstruck, Chief Municipal Analytical Officer at S&P Global Ratings. She joins us here on site at Build America Mutual. Nora, thanks so much for joining us here. Assigning ratings, talk to us about the credit quality that you see out there in the municipal bond market. I can't remember the last time we had a Puerto Rico, in Illinois. What's going on out there? It seems pretty good.
Yeah, thanks for having me. And I would say that, generally in 2025, I like to say that the municipal sector is cautiously stable. A lot of state and local governments are coming into 2025 still sort of riding some high liquidity and reserve levels based on the COVID relief.
Still?
Still, yeah. It had, they had to commit it all by the end of last year, but they have to spend it all by the end of 2026. So they still have some in their coffers generally. And I think also just the economy has been pretty good, and that helps state and local governments and other entities that we rate in terms of the demand that they see for their services.
When it comes to something we've been talking about the last hour and a half or so, are the impact of natural disasters and the LA wildfires. Like, how do you deal with ratings and natural disasters like that?
So we bake risk into our ratings, as you might imagine, as credit analysts.
But that probably wasn't on anyone's bingo card.
So we, in California, particularly in the utilities sector, watching wildfires from a credit risk perspective because of the fact that the state has inverse condemnation, which means utilities, even if they are not negligent, can be liable for sparking a wildfire.
If any of their equipment is involved, even if they didn't cause it.
Yep,
right.
Absolutely. So actually, LADWP, we lowered from AA to AA minus a few years ago because they choose as a decision not to de-energize their lines relative to wildfires. And that's fine for them to do that. It's different than some of their peers in California who do that. But because of that, they decide that because they're based in an urban area, they don't want to shut off their traffic lights. They think that the risk trade-off between the wildfire and human costs are not equal. So we lowered their ratings, and I think part of that is the inverse condemnation, but also it's just the fact that utilities are particularly susceptible to infrastructure damage during a severe weather event, whether it be a wildfire, a hurricane, flooding. So it's all been baked into our ratings. The actions that we took on LADWP were partly reflecting a recalibration of that risk as wildfires have come into more urban areas versus where they historically have occurred in rural communities.
I guess in response to the LA fires, President Trump, I think, has voiced some displeasure with FEMA and even suggesting maybe some of the disaster relief responsibilities at the federal level of FEMA be put down at the state and local level. Some people think that's a good idea. My question is simply, can states and local municipalities afford that kind of stuff?
Well, we've historically said that FEMA is an important credit support for state and local governments. These disasters are increasing in frequency and increasing in cost. And absent federal aid, that would be a significant pressure for them, and absorbing all of the costs is just probably a little unsustainable at the current rating levels. I think what we are watching for is what he actually decides to do. Does he still decide to maintain the federal aid and shift it to a block grant for states, and then states are responsible for allocating it? Or, does disaster relief go away entirely? Those are two very different dynamics that we have to monitor in terms of how it relates.
What are the different options then for those two scenarios? How would each impact the muni market?
So I think if even a lower level of disaster relief for state and local governments. Right now, they typically get somewhere between 70 and 90% of the costs reimbursed from the federal government.
Wow.
If that goes to 20%, that's something that we'd have to consider. If that goes to zero, that's a whole nother decision on our part to determine what the liquidity and reserves of state and local governments and entities that we rate need to maintain as a buffer against these types of disasters. Now, if it just shifts from FEMA being the allocator and the distributor of funds to states in terms of a block grant, that probably could be even like a non-concern for us, if you will.
All right, as a credit rating agency, you get paid to worry.
We get paid to worry.
Aside from natural disasters, which can be an overwhelming topic, what are some pedestrian things that concern you?
Well, I think generally we look at long-term liabilities, right? So pensions and how state and local governments and other entities that we rate manage their pension systems. Typically, it's managed at the state level. What does that mean? We are increasingly seeing more people retire. So how do those costs get baked into the budget? States in particular are a safety net for Medicaid, and that's something that President Trump has also spoken about in terms of modifying that plan. States get a lot of money to support people that are vulnerable and need to be in those programs. How could that change the way states function and what they need to allocate resources to? I think we also watch labor productivity and labor workforce dynamics. I think, one of the things that we noted after the election is that immigration has been good for our workforce in the U.S. It has really lowered the cost and the tightness of the labor market that has turned into high increases in salaries and personnel costs for state and local governments and entities that we rate. So a major change in border security could tighten that labor market right back up, and that could put additional cost pressures back onto these entities that we rate.
I mean, on the flip side, does it actually take away some of the state aid, though, also?
So it could definitely be a bit of a boost, right? So New York City in particular with asylum seekers had to absorb a significant billions of dollars in additional costs to help those individuals as they come into the city. That could definitely be a bit of a relief valve for them if that were to change. I think, too, there could be some cost savings relative to Medicaid, relative to other social services that they need to participate in to, come survive once they get to the U.S. So that definitely there could be some offsetting improvements in cost savings relative to credit quality.
Maybe you can explain to me how life works. Florida,
Yeah, okay, let's do it.
Texas, no state taxes. How do they build schools and roads and things like that? Because my property taxes are really high.
Yeah.
New Jersey.
I mean, I own a 550 square foot condo and my property taxes are $10,000 in New York City. So I hear you on that. What happens in states that don't have an income tax? Typically, they securitize other forms of revenue. So they securitize gas taxes, they securitize sales taxes, they securitize property taxes, which is typically the way most state and local governments secure the debt obligations that they have outstanding is through property taxes. So yeah, you're right. Those taxes are high, and some of it will go to paying off debt obligations for the entities that we rate.
You don't feel good about that?
Yeah, I don't know. Why do I have to pay these high taxes? And everybody's moving to Florida to escape taxes.
It's true.
All
No
right.
one likes paying the taxes.
Exactly.
Yes.
Well, what are some other key things that are that you guys are talking about right now, like on the desk?
Yeah, so I think, we're definitely watching federal policy. We're definitely watching how aspects of affordability cut across all of our sectors. So, I was the housing sector lead before I was the chief analytical officer, and we were watching, the lack of housing inventory and how that was affecting the entities that we rate, like state housing finance agencies and social housing providers, public housing authorities, how they're navigating that particular aspect. But it's playing out everywhere. So water utilities and public power utilities, some of which operate in LA County, we've been watching how they're raising rates to not only pay for deferred maintenance, but also for investment for adaptation to wildfires and other severe weather events. Some have been a little bit lax in doing that because it's been expensive to live in America, right? We've had an inflationary environment. We've had, higher costs associated with food. We've had higher costs associated with utilities. Insurance premiums are going up for property and casualty insurance. So all of those things are weighing on management teams, and they're looking at how they can dampen those costs as much as possible. So affordability is something that we're really watching. We're also watching, just demographics generally. Our higher education sector has been plagued a little bit. Some institutions have had enrollment trends that are declining, which is a big input to our credit analysis because it generates money for public and private higher education institutions. when those trends decline, they have to figure out how to create revenue other than through tuition and fees. So demographics, the aging aspect of America, people leaving the workforce, people, lower demographic trends of people coming into education providers, all of that is something that can be kind of a disruption to credit quality.
Just got about a minute left. To what extent are you concerned about the tax exemption of municipal debt and perhaps losing that or having that be limited?
I think it really goes back to the question of affordability. So for us, we don't advocate for policies. We only sort of evaluate how the policies play out when we know the details of them. So initially, whether entities issue tax-exempt debt or taxable debt really comes down to the cost of their capital and how that gets baked into property taxes, sales taxes, other types of allocations of resources that state and local governments need to be making towards people, towards pension and OPEB obligations, towards disaster recovery. So if state and local governments, through losing the tax exemption, have to pay higher debt service costs, because they're issuing taxable debt, that is really just going to sort of funnel down to that affordability question and probably result in long-term increases, potentially to property taxes and other taxes that secure debt service obligations.
Nora, thanks so much. Really appreciate it. Learned so much. Nora Wittstruck, Chief Municipal Analytical Officer over at S&P Global.